Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IBM.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick reminder before we jump in, you can check out the VIP Algos link that's, right down below in the description.
Yeah, definitely check that out. Lots of great tools in there.
So, okay, imagine waking up, right? You check your portfolio and you find out that one of the oldest, most reliable tech giants on Earth just evaporated, nearly a third of its total value.
Just poof, gone.
Gone in a matter of days. I mean, you're talking about billions of dollars in market cap simply vanishing into thin air. That is exactly what just happened to IBM.
It's pretty wild. I mean, a $40 billion haircut in a single week, that's the kind of wild volatility you'd expect from, I don't know, a speculative crypto startup.
Right. Not a 113-year-old pillar of the global economy.
Exactly. When a blue chip staple drops that violently, it demands an immediate autopsy. You really have to look closely at what's going on.
And that autopsy is exactly what we're doing for you today. Our mission here is simple. Did one of the most famous companies in American history just, fundamentally break its underlying engine? Or is the market just throwing a multi-billion-dollar temper tantrum?
Well, to get to that answer, we really have to isolate the noise from the actual numbers because, man, the psychological panic in the market right now is just deafening.
It's so loud. Let's start with that panic, actually, because the price action on the chart it's jarring. I'm looking at the data, and IBM is currently trading at $211.20.
Right.
And to put that in perspective for anyone listening, that is basically sitting exactly on its 52-week low, which is $211.03. So it's down, 36.5% from its recent high?
Yeah, roughly 36%. But the terrifying part is really the speed of it all.
Yes, the speed. A 28.48% plunge in just the last 5 days. So break down the mechanism here for us. What actually triggers a sell-off that severe in just 5 days?
So it was basically a cascading domino effect. It all started with a recent profit warning from IBM's management team.
Okay, so they sounded the alarm themselves.
Right. They signaled that their enterprise customers are shifting their spending. Like, the budgets are moving away from IBM's legacy hardware and their consulting segments.
Ah, okay.
But the thing is, the market didn't just view this as an isolated IBM problem. Algorithms and institutional investors, they immediately extrapolated that warning.
Oh, I see where this is going. They assumed the worst for everyone.
Exactly. They took it to mean there is a massive industry-wide IT budget squeeze happening globally.
So they basically assumed every corporate IT budget on Earth was suddenly shrinking and, IBM was just the canary in the coal mine.
That was the interpretation, yeah. The headlines reflect absolute capitulation right now. You look at the news feeds and it's just uniformly bleak.
Just total doom and gloom everywhere.
Total doom and gloom. Framing this as a broad market contagion, we're seeing intense skepticism everywhere you look.
Which, naturally leads me to push back a bit. Because if you're listening to this and seeing all the major institutions dumping this stock and the financial media is just uniformly negative, your instinct is probably to stay away too, right?
Of course. It's human nature to run from a fire.
Right. And the market isn't stupid. These hedge funds have armies of analysts. So if they're aggressively selling at $211, why shouldn't we assume they know something fundamentally terrible about the company's future?
Well, institutional analysts are brilliant, sure, but institutional trading desks, they are often forced into highly emotional or honestly just mechanical decisions in the short term.
Mechanical meaning algorithms just taking over.
Exactly. When you see a drop this violent, the mechanism you have to analyze is the trading volume. Right now, the 10-day average trading volume for IBM is running 1.75 times hotter than its 3-month average.
Wow. Okay, so there are vastly more shares changing hands every single minute than on a normal trading day.
A staggering amount more. In market mechanics, this is what we refer to as capitulation volume.
Capitulation volume?
Yeah.
Okay, explain how that works for us.
Think about a mutual fund manager, right? They usually have a strict internal risk mandate. If a stock in their portfolio drops, say 20%, they are legally obligated to liquidate the position to prevent further losses.
Oh, wow. So they don't even get a choice.
Nope. They don't get to hold and hope. The computer just sells it, period. So when you see volume running almost double the average during a crash, you are basically watching all of those forced panic sellers flushing out of the system at the exact same time.
They're just dumping the stock at literally whatever price the market will give them. just to get it off their books.
Exactly. And the interesting thing about capitulation volume is that it usually marks the final stage of a crash.
Like the grand finale of the sell-off.
Right, because once all of those forced sellers and terrified retail investors have finally thrown in the towel and sold, well, who is left in the market to keep pushing the price down?
The sellers are exhausted. There's nobody left but potential buyers.
Oh, right. Which is backed up by another metric in the data called the Relative Strength Index, or RSI.
Okay, RSI. I've heard of that. That measures momentum, right?
Exactly. It measures the speed and change of price movements. Right now, IBM's RSI shows the stock as historically oversold.
Meaning the pendulum has just swung too far.
Yes. The momentum has swung so far to the downside that the selling pressure is, mathematically speaking, unsustainable. Usually, this kind of extreme exhaustion signals the beginning of a bottoming process.
Okay, so if that $211 support level holds, the market has essentially flushed out all the fear, setting up like a structural floor for the stock.
Precisely. The fear is baked into the price at that point.
So the sentiment is terrible, but the selling might actually be exhausted. If the foundation is potentially stabilizing, this is the moment we really need to look under the hood at the actual business.
Right. Let's look at the actual numbers.
Because I'm looking at the filings here, specifically the revenue, and I want you to make sense of this disconnect for me. Despite this massive stock drop and all this panic about shrinking IT budgets, IBM's trailing 12-month revenue growth is nearly 10%.
Yeah, they are actually growing.
Which is crazy. A near 10% top-line growth rate for a company operating at IBM's massive global scale. That's highly significant.
It absolutely is. It proves that while spending might be shifting, like the management warned, it certainly isn't disappearing.
Right. And, their margins jumped out at me, too. I always picture IBM as this, legacy hardware dinosaur.
Yeah.
But their gross margins are sitting at 58.36%.
Yeah, you don't get almost 60% profit margins just selling physical servers and metal boxes.
You really don't. So
Yeah.
what's driving that?
That margin profile tells you that IBM is no longer primarily a hardware company. That growth and those margins are being heavily driven by their software segment.
Okay.
Specifically, a company they acquired a few years ago called Red Hat.
Okay, Red Hat. I know that acquisition was really expensive at the time, but break down how it actually fundamentally changed IBM's business model. Why does acquiring an open source software company give them 60% margins?
Well, to understand Red Hat, you really have to understand how modern corporations use the cloud today.
Okay, lead on me.
Most massive companies like banks, airlines, huge hospital systems, they don't just use one cloud. They use what's called a hybrid model.
So they mix and match.
Right. They might use, say, Amazon Web Services for their mobile app, Microsoft Azure for their email, and then their own private on-site basement servers to hold highly sensitive customer data.
That sounds like a logistical nightmare.
It is. The nightmare for a chief technology officer is trying to get all those different systems to talk to each other securely and smoothly.
It's like having 3 different offices that all speak different languages.
That's a great way to put it. Well, Red Hat is the universal translator. It is the underlying software architecture that seamlessly manages all of those different cloud environments at once.
Oh, wow. So they're the glue holding the whole network together.
Exactly. So by acquiring Red Hat, IBM essentially bought the toll booth. Now, whenever these massive enterprises need to scale their tech or move data between Amazon and their own servers, they are paying licensing fees to IBM.
That makes total sense. It transformed them into a high-margin, hybrid cloud powerhouse. So they own the nervous system connecting all the different parts of the enterprise.
Yes, that explains the 60% margins.
But, here's the number in the financial filings that really stopped me in my tracks. Over the last 12 months, IBM generated $12 billion in free cash flow.
Yep, $12 billion. And free cash flow is, honestly, the ultimate truth teller of a business's fundamental health.
Because earnings per share can be manipulated, right?
Highly manipulated. Earnings per share can be tweaked with accounting adjustments, depreciation schedules, or tax write-offs. But free cash flow, that is the actual, tangible, cold, hard cash left in the bank account after the business pays all its operating expenses, pays its employees, and maintains its equipment.
It's the money they actually get to keep and use. $12 billion of it.
That level of cash generation just cuts through all the market noise and panic. You cannot fake $12 billion in cash.
No, you definitely can't.
And it gives them an incredible amount of strategic flexibility.
Okay, but let's talk about the other side of the balance sheet, though, because it's not all sunshine and rainbows. I noticed in the filings that they have roughly $60 billion in total debt.
Yes, they do.
That sounds like a massive anchor dragging down that cash flow. I mean, $60 billion is a lot of money.
It is a very large number, absolutely, but context is everything in corporate finance. Analysts actually refer to IBM's current financial position as a fortress balance sheet.
A fortress balance sheet.
Yeah.
Even with $60 billion in debt.
Yes, because you have to look at what the debt was used for. The vast majority of that debt was taken on strategically to acquire Red Hat.
Ah, okay. So they took on debt to buy the high-margin software toll booth we just talked about.
Exactly. They bought a cash-generating engine, and against that debt, they are currently holding about $14 billion in cash and marketable securities right now.
So they have plenty of immediate liquidity to service the debt payments without stressing the business at all.
Ample liquidity. And they use their cash flow very aggressively to reward the shareholders who actually stick around. You know, IBM is what the market categorizes as a dividend aristocrat.
A dividend aristocrat.
Yeah.
I've heard that term thrown around a lot on financial networks, but what is it actually required to get that title? Is it just paying a high dividend?
No, it's actually one of the most exclusive clubs in the market. To be a dividend aristocrat, a company must have consecutively raised its dividend payout every single year for over 25 years.
Over 25 years. Wait, think about what IBM has survived over the last few decades.
Right. The dot-com bubble burst.
The 2008 global financial crisis.
The COVID-19 pandemic.
Wow. And through every single one of those macroeconomic disasters, IBM still generated enough cash to pay out more money to their shareholders than they did the year before. That's actually incredible.
It is. They also use that cash for active share repurchases, buying back their own stock to increase the value of the remaining shares.
Okay, so the financials are incredibly resilient. They have the cash flow, the software margins, and the dividend history. But I want to explore the actual business model itself for a second.
The moat.
Right, the moat. We live in a world where AI startups are popping up every 5 minutes, it feels like. Why can't a shiny, well-funded new tech company in Silicon Valley just come in, offer a cheaper software solution, and eat IBM's lunch?
That brings us to the lock-in effect, which is arguably IBM's greatest asset.
Lock-in effect.
Right. The financial media gets very, very distracted by flashy consumer technology, but the unglamorous, heavy-duty legacy systems, the mainframes, those are what actually run the world.
The stuff in the basement.
Exactly. IBM mainframes still process the vast majority of global credit card transactions today. They run the databases for massive government agencies. They manage the logistics for global supply chains.
I always think of it like trying to replace the foundation of a skyscraper while thousands of people are still actively working inside the building.
That is the perfect analogy. The switching costs are astronomically high. They are practically prohibitive.
Because the risk is just too big.
Think about it. If you are the CEO of a global bank, you cannot just unplug your entire transaction database on a Tuesday and migrate it to a 2-year-old startup's cloud server.
Right, and that goes wrong, you're on the front page of every newspaper in the world.
The risk of catastrophic downtime, data loss, or a massive security breach is simply too great. So the risk of leaving IBM is infinitely higher than the financial cost of just staying.
Okay, so the customers are essentially trapped in the ecosystem, but in a functional, completely necessary way.
And this is where the strategy behind Red Hat and their new AI platform, watsonx, comes full circle.
Oh, watsonx, I wanted to ask about that.
Because IBM already owns that entrenched foundational layer, because their mainframes are already sitting in the basement of the bank, they have a direct, trusted channel to cross-sell new technologies.
So they don't even have to pitch to a cold lead.
Exactly. They aren't some outside vendor knocking on the door asking to pitch an AI product. They're the architects who built the building.
Right.
They can seamlessly and securely integrate their watsonx enterprise AI directly into the client's existing, highly secure IT stack.
They already have the security clearance, basically.
Precisely. They have the clearance, they have the trust, and they have the infrastructure.
Okay, so let's recap where we are. We have a company with a deeply entrenched, highly sticky business model that is printing $12 billion in free cash flow. But the stock is down nearly 30% because of a short-term panic.
Correct.
So if you're an investor looking at this, what is the catalyst? Knowing all this foundational strength, what is the specific event that is going to force the market to wake up, realize the stock is mispriced, and push the valuation back up?
Well, if we lay out the timeline for the next few quarters, the most critical checkpoint is the upcoming October 2026 earnings report.
That's going to be a big one.
Huge. That call is going to be the crucible for IBM's management. The market is going to demand empirical proof that the underlying business is stable.
Because the street isn't going to accept vague promises about the future anymore. They want to see if that initial profit warning was just a temporary blip or if it's the start of a real long-term downward trend.
Exactly. And the analysts will be laser-focused on the free cash flow guidance. If IBM's management comes out in October and reiterates that their cash flow generation is stable and they can show demonstrable recovery or growth in that high-margin software segment,
Then what happens?
you could see a massive and immediate re-rating of the stock. The capitulation sellers will realize they overreacted, and institutional buyers will rush right back in.
There's also a much larger macroeconomic picture that we need to connect here. I noticed a recent producer price index, or PPI, print in the economic news feeds we were looking at.
Ah, yes, the macro factors.
Right. The PPI came in softer than expected, which is a really strong leading indicator that inflation is cooling down.
And a cooling inflation environment completely changes the behavior of the Federal Reserve.
Because if inflation is under control, the Fed will begin cutting interest rates, right?
Exactly.
So explain the mechanism there for the listener. How does the chairman of the Federal Reserve cutting a base interest rate in Washington magically push up the stock price of IBM in New York?
It alters the entire calculus for large, income-oriented institutional funds.
Okay, how so?
When the Federal Reserve cuts interest rates, the yield on incredibly safe investments, like U.S. Treasury bonds, drops alongside them. So say a pension fund needs to generate a 5% return every year to pay its retirees.
Right. They have a strict target they have to hit.
Exactly.
Yeah.
And if Treasury bonds are suddenly only paying 3%, that fund manager has to go out into the market and find yield somewhere else.
They are forced to take on slightly more risk in the stock market to get their necessary returns.
Spot on. And they look for the safest possible yield in the stock market. Because IBM's stock price just dropped 30%, their dividend yield, which, remember, is just a percentage of the stock price, just spiked significantly.
Oh, wow. So suddenly IBM becomes a massive magnet for all that institutional money rotating out of bonds.
Exactly. You could see a huge sector rotation where billions of dollars flow into legacy dividend-paying tech stocks simply because the big funds need the income.
The dividend basically becomes the main attraction.
Yep.
Now, speaking of macro factors, here's where things get genuinely fascinating.
Mm-hmm.
We've been looking at the geopolitical intelligence feeds as well.
Yeah, this is a very interesting angle.
Right. There are escalating global tensions right now, specifically the recent U.S. and Iran strikes around the Strait of Hormuz. Now, obviously, we're not a political show, but we need to analyze the economic ripple effects here.
Definitely.
How does a kinetic geopolitical crisis halfway across the world act as a financial catalyst for IBM's enterprise AI division? It sounds completely disconnected.
I know it sounds disconnected, but it fundamentally changes how massive enterprises and governments view data security.
Okay, break that down for me.
We are all very accustomed to consumer-facing large language models, right? The public AI interfaces you use on your phone to write an email or, generate a recipe.
Sure, the everyday stuff.
But international turbulence absolutely terrifies corporate boards. In a volatile, escalating geopolitical environment, the absolute last thing the Department of Defense or a global logistics company or a massive bank wants to do is feed their highly sensitive proprietary data into a public consumer-facing cloud AI.
Oh. Because the risk of that data being intercepted or hacked or used to train a public model is like a catastrophic national security or corporate espionage threat.
It is an unacceptable risk, full stop. In a high-threat environment, these entities require secure, localized, on-premise AI models.
On-premise meaning it stays in the building.
Yes. They need the artificial intelligence to live entirely inside their own locked physical vaults, completely disconnected from the public internet.
And that positions IBM perfectly because of what we talked about earlier.
Yeah.
Their watsonx platform is designed exactly for that.
The speculative chatter among defense and enterprise analysts right now is that this global volatility is going to massively accelerate enterprise demand for on-premise AI.
So they may start scooping up contracts.
It could potentially land IBM some staggering federal defense and banking contracts because, again, they don't just sell the AI. They have spent the last century building the secure vaults that these institutions already use.
The logic there is incredibly sound. It really is. So we have potential federal defense contracts driven by security fears. We have macroeconomic interest rate cuts driving dividend hunters to the stock. And we have a deeply entrenched mainframe system printing cash.
It's a strong case.
It sounds like an absolute slam dunk. But, our job is to look at this objectively and tear our own thesis apart.
Always.
We have to explain both the upside and the downside clearly. Let's flip the script and look at the risks. What is the actual bear case that breaks this entire optimistic outlook?
Well, the most potent bear case is rooted in the harsh reality of today's corporate budgets, rather than the theoretical AI potential of tomorrow.
Okay.
The mainframe headwinds that caused the profit warning in the first place, those are very real. Enterprise customers are currently feeling an economic pinch, and they are actively delaying their hardware upgrade cycles.
So they're just sweating their current assets longer.
Exactly. And that delay is aggressively compressing IBM's earnings per share in the immediate present.
And while you mentioned global volatility driving defense contracts for secure AI, the flip side of that coin is that broader macroeconomic fear often just freezes enterprise IT budgets entirely.
Right, that's a very real threat.
If a bank's CEO is genuinely worried about a widening global conflict or a deep, prolonged recession, they might not shift their spending to secure AI. They might just stop spending altogether.
They just pull the plug on everything.
Right. They lock down all discretionary budgets until the economic storm passes.
That is the primary vulnerability of the bullish thesis. The entire AI growth model relies on enterprise customers executing a budget shift, moving money from old servers to new AI software.
But if they don't shift and they just freeze...
If the spending simply evaporates due to a budget freeze, IBM's timeline for revenue recovery gets pushed out by years, and the stock could languish at these lows for a very, very long time.
That's a huge risk.
Yeah.
And there was another specific data point we found that usually makes retail investors incredibly nervous, and I really want to address it.
Okay, what's that?
Insider trading action.
Yes.
If you're listening to this and trying to decide what to make of IBM, your first thought is probably, well, what are the executives inside the company doing? Are they buying the dip or are they jumping ship?
It's a fair question.
I looked at the raw SEC Form 4 data, and over the last 90 days, there were 14 buys and 5 sells by corporate insiders, resulting in a net decrease of 737 shares. So the insiders are technically selling more than they are buying. Doesn't that mean they see the iceberg coming and are quietly getting into the lifeboats?
It is incredibly important to contextualize insider trading data because raw numbers can be highly deceptive. Yes, the data shows a net decrease, but we are talking about exactly 737 shares.
Right.
For a multinational corporation with a market capitalization in the tens of billions of dollars, an insider volume of 737 shares is entirely mathematically negligible.
Okay, so it's not the CEO quietly dumping half his net worth before a bad earnings call.
Not even close. A transaction size that small is almost certainly just routine corporate housekeeping.
Like what?
It's an executive doing some minor profit-taking to pay for a house, or more likely they are automatically selling off a small portion of shares that just vested in order to cover the income tax bill on their compensation package.
Oh, that makes sense. Just paying taxes.
Yeah. It does not indicate any sort of systemic lack of internal confidence in the company's future. If the C-suite were genuinely terrified of a foundational collapse, you would see coordinated insiders selling in the tens or hundreds of thousands of shares.
Okay, so the insider selling data is essentially a red herring that we can safely ignore.
I would say so, yes.
The real, tangible downside risk is a prolonged, macro-driven IT budget freeze.
Exactly.
So we have to synthesize all of this. We've analyzed the terrifying 28% drop in the capitulation volume. We've looked under the hood at the $12 billion in free cash flow, the Red Hat hybrid cloud margins, and the Fortress balance sheet.
It's a lot of data.
It is. We've weighed the upcoming October earnings catalyst, the macro rate cuts, and the geopolitical AI security demands against the risk of frozen corporate budgets. Bottom line this for the listener's wealth-building perspective. What is the final verdict from the research?
Well, when you aggregate and weight all of these fundamental and technical data points, the research yields a final bullish score of 7 out of 10.
A 7 out of 10? That's solidly optimistic, but it clearly acknowledges the structural risks of the hardware slowdown.
It is a measured, data-driven optimism. Right now, IBM is trading at a price-to-earnings, or PE ratio, of 18.8x.
Okay, briefly explain why that specific multiple matters in this context.
A PE ratio essentially tells you how much you are paying for $1 of the company's profit.
Okay.
At 18.8x, you are paying $18.80 for every dollar IBM earns. In the modern tech landscape, where companies like Microsoft or Nvidia routinely trade at multiples of 35x, 40x, or even higher, a PE of 18.8x is historically fundamentally cheap.
It's a massive discount compared to the rest of the sector.
Exactly. The structural analysis literally dubs this a timely buying opportunity after the collapse.
Right.
But there is a massive caveat to that optimism, and the key word is time.
Time.
The research classifies this strictly as a multi-year horizon. We are looking at a 12 to 24-month view here.
Meaning this is absolutely not a get-rich-quick swing trade where you get in today and expect it to bounce back to its all-time high by next Friday.
Not at all. The underlying mechanics of enterprise software sales take quarters, not days, to materialize. This is a classic asymmetric value play.
Right.
The massive downside risk appears to be largely priced into the stock already by that violent, emotional 28% drop. As an investor looking at these levels, the view is that you are essentially looking at a world-class cash-generating asset at a heavy discount.
And while you wait for the enterprise AI monetization cycle to fully scale up and prove itself on the balance sheet, you are being paid a very robust, historically secure dividend just for holding the stock.
Exactly. You are getting paid to wait out the market's temper tantrum.
Wow. We have covered a massive amount of highly complex ground today. We started with a terrifying chart that looked like the end of a legacy titan, with the market in full-blown panic mode.
No panic.
But as we dug beneath the sensational headlines and looked at the actual mechanics of the business, we found a bedrock of $12 billion in free cash flow, astronomically high customer switching costs, and the quiet, deeply integrated power of their secure enterprise AI.
It really highlights the vital importance of not just trading the news headlines, but actually reading the balance sheet and understanding how a business functions.
Absolutely. So for you listening, this is the ultimate takeaway from today's analysis. When the market is screaming sell, when the volume spikes and everyone is running for the exits in a panic,
Yeah.
sometimes the most profitable thing you can do is stand perfectly still, look past the emotional noise, and check the actual underlying math.
And as you think about that math and you look at the future of the tech sector, I want to leave you with one final thought to mull over.
All right, let's hear it.
We spend so much time in the financial world obsessing over which flashy, well-funded new startup in Silicon Valley is going to build the smartest, fastest artificial intelligence.
Right. Everyone's looking for the next big thing.
But think about how the physical world actually operates. If the world's most sensitive, mission-critical data like global banking ledgers, national defense logistics, power grid infrastructure, if that is already locked securely away in legacy on-premise vaults, won't the ultimate winners of the AI revolution simply be the companies that already own the keys to those vaults?
Man, something to seriously think about.
Definitely.
Well, if you found this analysis helpful, please remember to subscribe, like, and comment underneath. And don't forget to check out the VIP Algos link in the description below for more tools and insights. Until next time.